I have some questions about my cash funds. I have several accounts for myself and our minor children. And as partners, I've been using Dan's allocation for the cash funds that are available. And, I'm putting my emergency fund money in these and my cash allocations for my portfolio in these funds. Basically, those have just been shrinking for the last several months. And I'm kind of wondering if I'm supposed to convert those to some sort of money market vehicle for the time being until we get some clear direction moving forward, or if these are going to continue shrinking, and if I should be concerned about that at all. What's your take on that?
So I would expect that those things would continue to be on the list. Now, Dan has always said that you are going to see some volatility in those things. So if it is emergency money, I would prefer having emergency money. And what I define as emergency money is any money that you might need to spend in the next 6 months to 2 years. So if you needed tires on your car, replace an appliance, pay a deductible, if you lose your job and you have to use it for living expenses, I think that money should just be reserved for, money market, savings accounts, checking accounts. It's been really hard to do that in the last several years because the interest rates on those types of accounts are just so low. But the main goal for that kind of money is just stability so that it's there when you need it. What I would say is with those types of inflation protected funds, that as inflation goes up, the interest rates on those securities go up. Since they are bond funds, we've seen the value under pressure. What we should be seeing over time is that the interest the interest or the dividends that you're getting on those funds start to increase as some of those mature and get into higher paying, current bonds. So I wouldn't, if it's just part of your cash allocation, that you're just kind of keeping for stability, you're going to be getting a higher interest rate on it than what you would get just in a money market or a savings account. And if you can wait out the volatility, I would say to wait it out, if you've got a couple of years, because, it's not just the value of whatever you have in that particular fund. You have to remember that you're getting paid interest and a lot of times monthly. We tend to forget that as that interest just kind of dumps into our money market account, or whether you have it going, paying out to your money market account or just going back into the fund itself, which the strategy here involves having it just go into your money market. So you can't forget about those dividends that you're earning.